Investors have another risk to consider with the U.S. government shutdown underway. Joining us now to discuss what it could mean for the markets, Jeff Evans, VP Director and Lead for Empirical Research and PM Support with TD Asset Management. Jeff, always good to have you on the program.
Great to be here. Thanks for having me.
Markets are fluid, obviously. We don't know what they're going to do from 1 minute to the next, but it seemed heading into this, we did see, what we'd expect in perhaps gold and bonds and in equities. But when we think about a government shutdown and the mechanics of it, what does it actually mean for the markets longer term?
Yeah, so it certainly hasn't been a dull year in Washington, lots going on. But I think what's important for investors to keep in mind on a government shutdown, typically these are short-term events, last for a couple of days. Most government shutdowns are less than a week. And the main reason for that is that these are very expensive. Now, obviously, for the federal government, not so much. They're not spending any money over the next little while where they're shut. But when you think about all the knock-on effects from that, all of the businesses, all of the consumers that are either directly exposed to this, 700,000 federal workers potentially furloughed, and then all the indirect impacts on other businesses, services spending, and so on. When we've talked to economists about this, the typical impact would be about 0.25 to 0.5% of GDP per month of shutdown. So it's not big in the context of the U.S. economy, but if you think about it in terms of economic growth, the U.S. economy usually only grows 3 to 4% a year. Half a percentage point is potentially a fairly big hit to growth. So I think that's the way we're thinking about it. It is a much bigger impact on the growth side of things. And one of the things that makes this shutdown potentially a little bit more interesting or concerning is most shutdowns are less than 7 days. But if you look at the last shutdown in 2018, that was actually the longest on record at 35 days, also under the Trump administration and in a period where we had very strong partisan politics. Nobody wanted to get together or compromise. And what ultimately led to that was you had a number of federal workers that refused to actually come back and perform essential services. LaGuardia Airport, for example, I think was shut down at one point. And that's what kind of forced lawmakers to come back and sort things out. The other dynamic here as well is there's a lot of posturing going into the midterm elections for next year. Lots of politics behind the scenes to figure out who could be blamed for the shutdown. And so you're already starting to hear from some of the senior leaders, the Democrats and Republicans, that this could stretch out even longer than 2018. And I think that's maybe where there's a little bit of concern. The other thing to keep in mind in the shutdown in 2018, it was only a partial shutdown. The government actually had funding for about half of the departments. So half of the government stayed open, half shut. In this shutdown, none of those funding bills have been passed. It would be a full shutdown. And when we think about the potential impact, it gets you probably closer to that 0.5% of GDP. Again, we don't really know exactly what it would be, but probably a bigger impact than what you saw in 2018. As far as the impact for overall markets, when we've looked at this over time, usually the equity markets look through these sorts of events, again, because typically it's a short-term event, less than a week. Even if it does stretch out to a month and it's a half a point of GDP, in the context of the next 100 years of U.S. economic performance and corporate earnings, it's really a drop in the bucket. So equity markets tend not to react too much to this. And in fact, in the 2018 period, markets sold off into the news, and then as soon as the shutdown happened, equity started to rally. It's kind of similar to what we've seen this morning. Started negative and then back in the green fairly quickly. I think the bigger concern here is we're not going to get economic data. It may not be just the jobs report. It could be inflation, could be news about jobs over time, and that has the potential to impact Federal Reserve decision-making. If they were to put their cutting campaign on pause, that's where you might see a bigger equity market reaction. So I think what we'd be watching here is the tone from Federal Reserve officials over the next couple of weeks. I mean, the other piece of this, too, is they're also going to be taking into account that 700,000 federal workers are going to be furloughed. That probably shouldn't cause them to cause their cutting cycle, but I think that's the key thing to focus on. It's really probably the Fed and Fed policy that has the potentially biggest impact here over the next few weeks.
Lots of moving pieces there, and obviously we need to keep a careful eye on the developments. Other pockets of the market, obviously real estate and infrastructure when we have you on. We talk about that quite a bit. The real estate outlook, are some of parts of the sector starting to pick up?
So it has not been a great 5 years for real estate, and the main reason for that has been obviously a 40-year increase in inflation, a very significant inflation increase that also led to the biggest and fastest increase in interest rates in 40 years. For a leveraged sector like real estate, that was a pretty significant headwind over the last few years. But the good news is we're now mostly through the end of that adjustment process. A lot of the REITs that issued cheap debt in the pandemic, that's starting to roll over at higher levels today. What that's meant is a lot of the rent growth that REITs have achieved over the past few years, especially just going to the banks to pay higher interest expense. But as that debt reprices, and we've got maybe a little bit more in 26 and 27, but the bulk of it is done, that should allow more rent growth to move to the bottom line and ultimately support higher growth from real estate over time. What we're also starting to see is we're seeing reaction in asset values. So we're starting to see more transactions in the market, maybe a little bit of a pause at the start of the year with tariffs, but certainly over the summer we're hearing more and more leasing activity, even in office, surprisingly, given some of the concerns over AI. We're seeing lots of office activity in places like New York and San Francisco. Broadly speaking, real estate transaction market activity is picking up. And that also tends to produce a more positive view of the sector going forward. When we talk to some of the bigger players as well, the Brookfields, the Blackstones, the BlackRocks, that have a significant private market exposure, all of them are starting to make moves. We've seen a couple of fairly large deals recently, including a warehouse deal in Europe just this week of a couple $1 billion. So you're seeing the bigger players also becoming a lot more active. Really the key thing for us, occupancy's actually stayed pretty stable over the last couple of years, and that's really the core driver of real estate performance. If there's demand and tenants want to be in the buildings, that's the key thing. There's a few moving parts in certain sectors, but broadly occupancy stayed stable. The key is rent growth. With all of the economic pressures, it's been harder to push rents, sometimes because of interest rates, sometimes because of inflation. There's also been a lot of extra supply that's come into the market, particularly in residential and industrial. Taking a little bit of time to work through that, but as we look into 2027, that's when a lot of that supply disappears. We should start to see a more favorable interest rate backdrop. Ultimately, that becomes a much more landlord-friendly market as you get out. So 2026 maybe still a bit of a transition year, but the markets, of course, will look through that. They'll start looking into 27, 28, and we're becoming more constructive as we get closer to that we can start to see some acceleration in rent growth and overall cash flow growth from the REIT sector.
Very interesting stuff there on the real estate front. What about the infrastructure space? What are we thinking here?
So, in a number of different moving parts there. Maybe start with utilities. The big story on the utility side continues to be, of course, data centers. We continue to see an enormous amount of demand for data centers, and the significant announcement a few weeks ago with Oracle and OpenAI. This just continues in a pretty significant way. We're not seeing any signs of hyperscalers pulling back their capex. All of that leads to significant electricity demand over the next several years. And this data center, everybody's talking about it today, but it's really not going to happen until 27, 28, 29. It's going to take a long time to get the infrastructure in place, and that's when you start to see the pickup in power demand. The other big development is the One Big Beautiful Bill Act that came out over the summer. Bonus depreciation is going to be a huge driver for investment into next year. Still a little uncertainty on how the Treasury is going to apply certain rules, so companies are still waiting to really get aggressive, but as you get into 26, we should see more construction of warehouse and manufacturing facilities, and ultimately all of those need electricity to function, same way as data centers. What that means for utilities, 5 to 8% or 6 to 8% earnings growth is what most utilities are guiding for. Maybe a little bit closer to the high end of the range given how much is going on in the U.S. Because of just the number of different demand drivers we're seeing, it's not just 1 or 2 years of EPS growth, it's potentially 5 to 10. So it's creating a very, very visible pipeline of growth for utilities. Remain pretty constructive there. And then the pipeline side, maybe that's the other flip side of this. You mentioned earlier oil prices being a little bit weaker. What you tend to see in that environment is a relative trade where the Canadian pipes, so Enbridge and TransCanada, tend to outperform when commodity prices are weaker relative to the U.S. pipelines. That's generally what we've seen over the course of the year. So on a relative basis, stronger performance from the Canadians. In the U.S., one interesting thing that we've seen this morning, Targa, which is a pipeline out of the Permian Basin, announced a new pipeline coming into service in 27. That's interesting because there had been some concerns about Permian growth slowing down and maybe a lower volumes coming out of that basin. This is, I think, a vote of confidence in the long-term prospects for that. But what we're broadly seeing in the U.S. is it's a focus on gas pipelines, which brings you right back to the data center thematic. So it's companies like Williams or DT Midstream that have a very significant focus or platform near where data centers are. I think that's what we've generally seen within the pipeline space. So preference for Canadian names if oil remains relatively weak, and then a preference for gas names is where we see the greatest opportunities in that area.